Welcome to the Slop Temple. We pray this video helps.
You start by quantifying risk and setting a clear trading thesis. Define your risk per trade, dollar or percent, and pick strike, expiry, and delta that match that thesis. Once done, set an initial profit target and a stop-loss level so you know when you will exit. Make sure to record entry price, bid/ask spread, and implied volatility. These numbers guide adjustments. You will now open the position and monitor Greeks and price action for the next steps. After entry, monitor Greeks and market context to decide adjustments. You check delta, theta, and vega regularly. If delta drifts, hedge or scale to restore intended exposure. Once you see meaningful Roman for compression or a price move toward target, tighten stops, or take partial profits to lock gains. Make sure to rebalance rather than panic sell. Gradual scaling reduces execution cost. Record each adjustment and rationale so you can replicate successful tweaks and avoid repeating mistakes. To finish, execute the exit aligned with your plan. Take full profits at the target, scale out when partial goals are met, or close if time decay and theta erode value. Once closed, log P&L, trade rationale, and execution details to learn quickly. If results deviate, troubleshoot by checking position sizing, slippage, and implied volatility changes. If needed, adjust future target setting or entry filters. Remember to iterate. Make one.
Thanks for watching. Consider subscribing if we helped you.